The EU's trillion-dollar action plan is working for now. Stocks are up worldwide. As Deirdre just told you, the euro is back above $1.30 and volatility is way down. But haven't we seen this all before? Volatility backed off in October 2008 after the U.S. Congress moved to stabilize the financial system. It then soared to record levels just weeks later. Here to tell us whether it's any different this time, Maneesh Deshpande, head of U.S. equity derivatives research at Barclays Capital. He leads the top-ranked derivative strategy team, according to Institutional Investor, making him a Bloomberg best. Maneesh, glad you could join us this morning. We are seeing a massive pullback in European volatility this morning. Should we expect to see the VIX respond similarly after U.S. markets open?
I think you'll certainly see that. I think VIX is probably going to come down certainly below 30, but I don't think it's going to come down substantially below that. And I think you put your finger right on the matter there, that given the experience from 2008, investors are going to be very skeptical about the current package.
All right, well, let's talk, though, about where volatility might go back to. Do you think that something in the order of 35-40 is what we might see for the coming weeks, or possibly even higher than the levels that we saw it hit on Friday?
I think that is sort of hard to gauge at this time. Obviously, the situation is changing very rapidly. But I think the key is going to be, although we have some details on the package, it's not clear the actual reaction from the actual governments on how these things will be implemented. So just based on that, there's likely to be a substantial amount of uncertainty on the VIX.
Okay, Maneesh, I want to ask you a question, though, about the expectations for volatility heading into last week. It wasn't so long ago that the VIX was down to 15, and that really defied the predictions that we heard going into this year after the experience with the financial crisis. Lots of people were saying we were going to see a permanent repricing of volatility, and then vol fell back down not too far off its long-term average. How come everybody got it wrong and they're paying the price again now?
Well, I think it's partially true that it is certainly true that VIX itself had gone down substantially to the 15s, as you say. However, the long-dated volatilities, if you look at 1 year equivalent of 1 year VIX, that had stayed quite high. That had stayed sort of in the low 20s. And the interesting thing about this rally here was that this current sell-off was that this longer-dated vol itself rallied substantially. So during typical risk flares, shorter-dated vol rises rapidly, and longer-dated vol only follows suit when the crisis shows signs of being a protracted affair. On the other hand, over the past few days, last week, longer-dated vol, which was already elevated to begin with, has risen even further.
Okay, why was, though, let's try to, if you can, with about a minute left, explain to us the relationship between the kind of action we're seeing the European policymakers take and the expectations that we see borne out by implied volatility. Does what you see, the trading patterns you saw last week, because there was a big expectation that the European policymakers were coming in, does it suggest to you that their actions just aren't going to be enough to stem the speculative tide?
So I think just based on the pattern of the price action and volatility over the last week, the investors, at least the option investors, believe that the volatility is going to stay high for a substantial amount of time. As I said, the longer-dated volatility had reacted much more significantly than what you expect from such a risk flare. So I think we'll see how it reacts today. But I think in general, if investors, yes.
We got to run, Maneesh. I'm sorry.